Hi, I'm Andrew Bell from the Ray White Bell Group. I've been in the industry some 50 plus years and met some of the most amazing people. And I've always been fascinated by their journeys. People who started with nothing and created something. People who've faced some of the biggest setbacks and taken the biggest risks. And I've always wanted to know more about their defining decisions, what made shape them to be who they are. I created the Andrew Bell Conversation because I've always believed that the most powerful stories are the ones that people rarely tell publicly. Beyond success, titles, headlines are the moments that truly shape a person. The pressure, the setbacks, the risks, and the defining decisions. Hope you enjoy this month's episode, and don't forget to subscribe to future conversations. Okay. Nerida Conisbee, what a great thrill to have you here. We've had a lot of fun together over the years because we have this common love of real estate.
Yes, we do love real estate.
And it's not just buying and selling houses, it's everything to do with physical real estate. So can I get a bit of an insight from you about your journey? Born in Sydney?
No, born in Melbourne.
In Melbourne.
I don't know how far back I take it. So my first generation, mum German, dad Lithuanian. Did well at school, was very good at maths. And
it helps.
It helps, yeah. And then ended up getting into Melbourne Uni to study a Bachelor of Commerce. So went and did that, was planning to do actuarial studies and did the first year of that. Found it a bit boring, but I really liked the statistics and the econometric side of that first year. So I ended up taking that route, looking at econometrics primarily, so a lot around data and statistics and forecasting.
Sounds exciting.
It was exciting. I mean, I think as someone who is very good at maths, it made it more real world focused. And so for me, it was kind of like taking maths, which can be quite theoretical, into something that's very practical. And so that made it interesting for me.
So how did you end up in real estate? What was you finished uni? Where did you go next?
Yeah, so I ended up working as a research assistant to Ian Harper, who's on the Reserve Bank board, and then got a job at a company that specialised in forecasting for commercial property owners. So it was a really tough time in Melbourne. It was early 90s. I think youth unemployment was like 30%.
Yeah.
So I felt very lucky to get the job. I got a Ansett Golden Wing Club card.
Wow, I really made it.
And I really thought I'd made it. I was, a wallet full of plastic. And it was really amazing because the clients of this company, they were called Jeb Holland Demazi, they're now part of Urbis. They did forecasting for big property groups like Westfield, Lendlease, AMP, and a lot around commercial. It was very commercial focused, so shopping centres and office buildings and precincts and and so that's how I got into property. It was a bit of an accident because, I'd never meant to get into property. As an economist, at the time, particularly, economics led you into two places, banking or government.
I was going to ask, one thing about the statistics, and you can produce those sort of reports, but you actually went more into being an economist. That is more than just the statistics, isn't it?
Yeah.
It's forecasting and making maybe more judgments around what's happening and being able to read the market.
Yeah, and it was very, obviously I had to have an understanding of kind of the more generalist macro view. It was very micro, and the sorts of things we were looking at were, things like retail trade and economic growth and unemployment. But then we were also looking at things like very localised spending habits and population growth and a lot of mapping and trade areas. And it really led to a fascination with the dynamics of property and the complexity of it. But also got me into the industry, and people in property are fascinating. And I think that was also something that, opened my eyes that there was this whole industry that I had no awareness of, and led to this lifetime career and fascination with property.
So now this is officially, there's metrics to measure this, but you are the most quoted person on Australian real estate.
I'd say, it probably jumps in and out over time. But I would definitely be up there, and at times would be the most quoted. So, listen to the data person, I have to be exact. but yeah, absolutely. I would be at at times. Absolutely.
So just to start off with, we are one of the most expensive real estate countries in the world, aren't we? Is this like, you've got this fascination with real estate? I've loved it all my life, all my career. I've loved it. Is that just typical of Australians, more so than anywhere else, that we have this fascination? We want to,
We're obsessed.
get into it and be part of it?
No, I mean, there's a lot of countries that are obsessed with real estate. I mean, China's a good example, a lot of Asian countries. I think one of the things that's helped is that we have had prolonged growth and people have done very well out of property. And so if you have a look, particularly places like the US and the UK, the global financial crisis really led to a shift in people's attitudes towards property because property prices plummeted so much. And so people really got caught out. Here in Australia, we've had this sustained growth over a prolonged period, and it's been a pretty safe option as well for people. And I think that's the other part of it. We talk a lot about price growth, but at the same time, it's also the fact that people can preserve capital over a long period, which has made it very safe.
Our audience today are people that want to understand real estate more, and probably more so right now because there's a lot of new turbulence that's happening in the property market as a result of economics and so on. So I want to kind of just get to some real fundamentals of the real estate market, so all of us can understand the drivers that you've observed and through all your time as a leading economist in property. So I think of things like the measures that I see as significant, and tell me if I'm right or wrong. Population growth.
Yes, absolutely.
So how significant is that to what's been driving our market for 100 and something years?
Yeah, I mean, it's absolutely important. And I think one of the really interesting times was following the pandemic when we started to see those very rapid interest rate rises. And at the time, a lot of people who a bit sort of property adjacent was saying, oh, well, property prices are going to plummet 20, 30%, interest rates are going up, people won't be able to afford to pay it off. But what we were seeing was quite different, and what we were seeing is understanding the complexity of property markets was important, but also the fact at the same time construction costs were increasing very rapidly, and so replacement costs suddenly were blowing out, which was keeping a hold on values. Population growth was recovering. We'd gone through a couple of years of negative net migration. Suddenly migration was picking up again. So all of those factors started to lead to supply problems. We didn't have enough supply, and prices kept moving. And then conversely, I think the other part of it was that there was a view that people wouldn't be able to pay off their mortgages, but then we also had very high savings rates through the pandemic, so people had money to be able to withstand that shock. But also we had a banking sector that was really wanted to work with people who were going through challenging times. And I'm making banks sound like nice people, but they're not necessarily nice, but they are businesses, and they have, over the last several decades, they have spent a lot of money building up loan books, and so it is in their interest to try and get people through tough times. So they were definitely working with a lot of people then.
So we hear lots of conversation about the population growth of our country is too rapid, immigration's too great, et cetera, et cetera. If we didn't have population growth, how would that affect the real estate market?
I guess, there's two parts of it. So obviously, fewer people, we need less housing. So, that, and I think this is an argument that a lot of people will put out and say, well, that's the solution. We can cut migration. The challenge we have, though, is migration does provide workers, and also more recent migrants do provide workers in industries where a lot of Australians don't particularly want to work. If you have a look at things like aged care is a really good example. Yeah. There's a lot of jobs like that. Childcare would be another one. Jobs that are not necessarily well paid but are crucial to our economy. That these
waiters at restaurants.
Well, particularly in places like the Gold Coast. So, there's that aspect of it. And then I think another part too is that if you have a look at, say, Southeast Queensland at the moment, Perth is the same, that international migration is playing a role in terms of housing demand, but it's also interstate migration, because you've got people coming out of Victoria and New South Wales to get jobs and to, not so much cheaper housing anymore, but, at the time there was affordability drivers, and those factors really led to, or continue to lead to a flow of people coming through.
So it's important for our economy,
Oh,
apart from real estate,
absolutely.
isn't it?
Oh, absolutely. If you think like one additional person, the amount of money that they spend is on one side, but also the employment that they provide. It's absolutely important to our economy.
I understand you may not have an answer to this, but we were close to 500,000 in population growth in the last census. So is there a number that's like a happy medium, like, oh, you wouldn't want to go under 250, or once you get over 300, it really has a big cumulative effect? Is there a kind of a magic number?
There's not, because as long as you can provide housing, and I think that's the problem that we've come against. And the other thing too, like, you can't force people to live in one location. You can encourage them to, and there's various measures to try and get people into regional areas, for example. But so there's that aspect. But if you have enough housing, you can. It doesn't matter. The problem is providing that housing, and also providing the housing that Australians want to live in. And I think this is the other challenge we have. When we talk about Australia being globally an incredibly expensive place to buy property, a lot of it's to do with the fact that we don't like high density, and we're not used to high density, and we love a backyard, and we want a big, and we want like multiple spare bedrooms. And if you look at the rest of the world, it's just not the reality that they live in.
So let's get on to interest rates. Always topical.
Yes.
And I can think in my career, I've gone from everything from 2 and 3% to 18%. So how big an impact are interest rates on real estate?
Yeah, I mean, obviously they're big, because people do have very high debt levels. So if you go back to the 18% time period, people's debt levels were much lower.
Yeah.
We're not going to get to 18% because there's no need, because, if you got to 18%, it would, you'd be wiping out everyone. So the Reserve Bank doesn't need to shift as much, because if they put them up by 0.25%,
a lot of big impact
compared to where we were 30, 40 years ago. So, it does have it has bigger impacts on some markets more than others. We can see in Sydney in particular, it is our most expensive city. People are much more sensitive to them. Go to Perth, for example, Perth historically hasn't been that sensitive to them, and other drivers have been more important. So yeah, they're very important, and also it obviously impacts people's ability to borrow, and so that impacts the price of housing on a daily basis.
So the interest rate movement is fundamentally attached to inflation.
Yes.
Correct?
Yeah, well, it is a Reserve Bank. The Reserve Bank targets inflation with interest rates
2 to 3%.
2 to 3%. Yeah, so it's their fundamental driver of why their main driver of setting interest rates.
So I've always seen interest rates like an accelerator and a brake in a car. They'll drop them when they feel the economy's slowed and they need to stimulate demand, buy things. And the reverse, of course. And we just see recent outbreak. We're hovering around 5% now.
Yeah, I know.
And so, this is why there's been a couple of interest rate moves, and there's more forecast. What's your kind of read on this? Is this inflation outbreak? Do you think this could be temporary? I know it's very much, it was happening before the war.
Yes.
So we already saw it rising. Now we've got the impact of oil prices. What's your read? Do you think it's with us for a long period? Do you think we're going to see a short burst of interest rate rises and maybe some easing? Like, where do you see it going?
So it is hard to predict, because we don't know when the conflict will end in the Middle East. So that's problem. And every time we think it's ending, it then comes back again. And, so there's a lot of uncertainty around what's happening to fuel, because if you have a look at the most recent read, it was 4.6%, but fuel was 40% up. So, clearly had an outsized influence. The other challenge too is that a lot of interest rate setting, a lot of the impacts of interest rate setting can't really control a lot of the inflation impacts that we're seeing at the moment. So if you have a look at, it's not going to stop the war in the Middle East, obviously, if we increase rates. We have very high construction costs at the moment, and that's a key component of inflation. It will slow down activity, but it's pretty, broad or a pretty hard way to do it. We know we need more workers, for example. It's not going to get more workers into the construction industry. It's productivity problems. There's all these other issues. And also rents, that's a really problematic one because that's a key component now of our higher inflation. But we know when interest rates rise, we see fewer investors. And if we see fewer investors, we see fewer rental properties. And as a result, that continues to accelerate rents. So there's a lot that goes on underneath it all, but fundamentally the Reserve Bank has, that's their main measure to try and get inflation down, and they do need to try and stamp out activity, and interest rate rises are the way to do it.
So if the Reserve Bank board was sitting around having a discussion about interest rates, what are the key factors that they're watching to make that decision about leave it as it is, increase them, decrease them? What are the key things that they look at?
Well, I guess broadly they'd be looking at two things. One's the inflation rate, which is clearly too high. It's at 4.6%. They'd also be looking at underlying inflation. So underlying inflation is taking out all the volatility. So the fuel prices are taken out. So that's sitting at 3.3%. So it's still above that 2 to 3% band. On the flip side of that, they're also looking at unemployment and economic growth. And this is where things start to look, at a headline level, look okay. Unemployment did remain stable last month. But when you look underlying what's happening, there are some pretty big problems. And there's probably two main ones. The first is Victoria. Their unemployment rate is sitting at about 4.7 at this point.
Yeah.
So that economy is
starting on
really,
the alarm bell stage.
Yeah, the alarm bells are starting to ring. And the other one, which is also alarming, is youth unemployment, which jumped from 9% to 11%. So young people are, they're impacted very early in a downturn, because when you've got casual staff or you've got young people, they're often, cheaper, more junior, easier to not have in your workplace. And so as a result, they do tend to lose their jobs quicker. And again, Victoria is quite bad because I think their youth unemployment rate is sort of 13, 14% at this point. So they'd be looking at both what's happening to the economy and also what's happening to inflation, and trying to work out, well, how do we keep this balance? How do we not force Australia into recession if we can help it?
So you see the complexity of this decision-making process. You go, we want to cut back population growth because it's feeding into demand for real estate, forcing prices up. However, we need more workers in key things like construction.
Well, you need them to build the houses for the population growth.
We need that population growth, but it's creating a problem in another regard. And so the overriding factors for them would be, irrespective of everything else, we've got to have inflation under 3%, and we'll just interest rate you into it?
Oh, no, they wouldn't. They would. I mean, okay, so if you have a look last cycle, New Zealand did that. So New Zealand was exactly the same as us with an inflation problem. Everyone had this same inflation problem. New Zealand started increasing rates very early, and they put them up far quicker and far more than we did in Australia. In Australia, we took a more moderate approach, or the Reserve Bank took a more moderate approach, and they started later and they didn't increase as much. And our economy got through it. We didn't go into recession. New Zealand went into recession. So what they don't want to go into, they don't want to force the economy into recession, but they do need to control inflation. And they do also need to control inflation expectations, because if people think inflation is going to remain high for a lot longer, it completely changes decision making. And a good example would be, a builder. If they're thinking, oh, well, inflation, the cost of petrol and the cost of materials is going to go up 10%. I'm going to have to start charging 10% now when I go in for quotes. And so that starts to change decision making on not just builders, it will change it for everyone. And then that forces inflation. And so you start to see a problem with people thinking inflation starting to lead to inflation. And that's what they don't want, an outbreak of that.
So I'm not going to put any words in your mouth, but I'm going to say this. Another 1% rise in interest rates over the next 12 months, would that be way out of it?
I don't know. I mean, look, no one knows. So I'm not unique there. I think there will be one more.
Well, yeah, there'll be one more. That's
one more will be a given.
No more in the second half of the year.
Look, markets are predicting more.
Yeah.
Yeah, they're absolutely predicting more. But we know markets will switch as soon as a data point comes out that either looks more negative or more positive.
Yeah.
So if the war in the Middle East finishes soon, if fuel prices start to come back, particularly if our economy starts to look very, very weak, I think they'll start to be a little bit more measured. And I think the other thing I think to keep in mind is that when we have a look at what the Reserve Bank are trying to do, they're trying to slow the economy down by pushing up rates. But fuel price increases are actually slowing the economy down as well, because if you think the average household, they're not spending as much on holidays because they're having to pay more for their fuel. So, it is slowing things down. So I think that's the other thing that we need to keep in mind.
So I've touched on population growth, we've touched on interest rates. We were just in the space of GDP,
Yes.
which is, I think, another big driver of real estate, because it affects unemployment, all those sort of factors. So I'm hearing a slightly more optimistic tone with you on that at the moment. Whereas, I think there's a bit of a negative sentiment out there. I think we're all saying government spending's out of control.
Yeah, that is out of control.
And that will have an effect. So there's a few ifs in what you were saying to me. If the war, and it's not just the war. I mean, they're not fighting at the moment, but there is
uncertainty.
The closure of the Straits of Hormuz and so on. I mean, there's stuff
a lot
going
on.
Yeah. So, and you just know, we know consumer confidence, which I'll touch on shortly,
yes.
is a big driver of everything. People getting out and spending money, buying things on their credit card or whatever. So I'm hearing you're saying maybe the pessimism, maybe some of that would be a reason why the Reserve Bank will go, well, you shouldn't put interest rates up, because there's enough pessimism and it's almost acting as a interest
downer.
rate rise.
Yes.
Would that be?
Yeah, I mean, that's a good way to put it. Certainly people are feeling very miserable. The ANZ survey of consumer confidence has shown record lows.
Well, it was a record. Yeah, it was
since 1973.
Yeah.
So terrible.
Wow.
So people are feeling miserable. Definitely unemployment, is rising. We don't have the data to prove it, but when we look at underlying data, when you also look at, there's a lot of high frequency data that's coming out now. So Seek, their advertising levels are now, I think they're on their 7th month down.
Yeah.
So that's looking pretty tough.
Yeah.
I think I suppose it does look like the economy is weakening. We don't know how quickly it will weaken. And we also don't know how hard the Reserve Bank will go in terms of rates, and whether they would be concerned that they have to push it so far to force us into recession. So, that's the other side of it, that we don't quite know if they have to do that. Ideally, they don't, and ideally things slow down, and then we get through this period in the same way we've gotten through it so many times before, because Australia is very resilient.
This time, I've always felt the Reserve Bank left it too late to make a move, and therefore had to go hard. I think this time they've started earlier.
They have,
which I think might mean that they don't have to go as hard. With steep rises or as quickly.
Yeah, so, I know they were criticised for going in too late. I don't, because of that New Zealand situation. Yeah. I don't think they did, but they were criticised. I think they'd be very conscious of that criticism, and as a result, they would be behaving in a different way. Although they're likely to behave in a different way this time. I think it is interesting looking at the US though, because UK everywhere has got an inflation problem at the moment, and they're like, people in the US are still saying, well, we're going to see cuts second half of this year. And, here in Australia, like, no one would come out and say that. And we're in the same situation.
Yeah. So why is it different in the US to us here?
Yeah, the US is very different. So you have, you've got finance commentators on Bloomberg still talking about rate cuts next year. And they're in exactly the same situation as us, with a rapidly rising inflation rate. So, I guess,
is that just a mentality?
I think it is. I think it's more of a conservatism we have here. That we don't have that same view that that people have in the US around interest rates. But it's a very clear difference at the moment.
So I don't think in my real estate career, 50 odd years, I don't think I've ever heard the word affordability used more than in the last 4 or 5 years perhaps, but particularly in the last 12 months. So this affordability, how's it coming into play now? How do you measure it?
Yeah. I mean, the way most people measure it is price to income ratio. So the price of a housing divided by average income. And clearly that is at record highs. I think if you look back in the 80s, it was like 4. So, divide the average house price by the average income, it was about 4. I think now it's like 16 or something. So, it's very, very clear that incomes haven't kept pace with what's happened to house prices. I think though, and following on from that, I think what does surprise me is that we still see very high levels of transactions, and we still see people buying, and people are buying later. So that's clearly impacting the
Age-wise.
Age-wise, yeah. There's also been a change in the way people buy. If you go back to the 80s, people would have been buying with a partner, whereas now a lot of people want to buy on their own, or they'll partner up with a sibling or a friend, so we've seen a change in that. Also, I think though, people are making money in different ways. So if you have a look at people, rent investing is a really good example. So before buying their primary home, they'll rent invest, make some money that way, buy back in. People making money off Bitcoin, like there's kind of investment options that people are looking at. And then I think probably what we really can't underestimate is how much wealth transfer is taking place. So a lot of people are getting money from parents, which is really helping
that's
them.
a new phenomenon.
Oh, sorry, the other one would be government support. There's a lot of government support out there to get people in.
So Nerida, there's this, over the last 30, 40 years, interest rate rises would result in people falling into arrears and go in and mortgagee sales. And you get a flood of properties on the market, and that'd bring prices down. If affordability is as bad as the measures are showing, is that a bigger risk? Or are banks changing the way they operate?
It should be, and I think that's what everyone expected when interest rates started to increase following the pandemic. That they did think there'd be a ton of people falling into losing their homes and the like. We don't see it. I mean, I think it is to do with the banks. If you have a look at if someone is coming under stress, they're having to. The banks are putting them on longer loan terms, moving from 30 years, 40 years. I think there's loans at that level. There is, moving on to interest only, which, so I think that flexibility didn't exist 40 years ago. Banks couldn't make those.
It was black and white.
It was
You're in arrears, you're gone.
Yeah. And then the other part of it too is, banks want to keep their loan books, so they're very keen to keep them there. And then, mortgagee sales are like the absolute worst. And you're right, we don't really see them. They're like, someone has to be completely unable
beyond
to
help,
bankrupt,
I
guess. But and the other thing too is that banks can recover costs if they sell. So the fact that we've had price rises as we have, and we continue to have because we have a shortage of property, if someone does go into if they can't pay off the mortgage, that person can sell their home and pay off the mortgage. The banks don't have to force them to do that.
So we talk about the fundamentals of real estate, and the most fundamental of all is supply and demand, isn't it?
Yes.
And so we know the demand's still there because we've got population growth. So on the supply side, we've all said the real issue for our housing crisis that we've had for some years now is this undersupply. Now the federal government's put housing package together and so on. It's just not happening, is it?
No.
It's just not happening.
No,
Why is that?
It's not happening. It's hard to build and slow and difficult and expensive. The target's the right one. If we did build 1.2 million homes over 5 years, we'd get there.
What are we at now?
900,000. It's nowhere near.
Not even a drop in the ocean.
No, and it's actually gotten worse since they've announced the policy. So it's the right target. We've never done that before. We've never built that many homes over 5 years. So the last time we got close was when there was a lot of capital coming out of China in particular, and there was enormous levels of development taking place in capital cities. So all those apartments in Melbourne CBD, Parramatta, North Ryde, all of those places just saw enormous levels of development because there was so much money flowing in. we don't have that money anymore. That's not flowing anymore. So that's a problem. Construction costs have gone up 30-40% since the start of the pandemic. So it's just expensive to build. And then planning has improved. I know a lot of developers will say it could be better, and obviously it could be better, but we know planning has become less restrictive, and in some places it's leading to a lot of new development. So a good example would be Melbourne, and people talk about Melbourne having such a slow property market because of the economy is not doing well. But the other part of why Melbourne is so cheap is that they build more than population growth, and they have been doing that for decades. So fewer planning restrictions have absolutely worked in that state and have led to high levels of development.
We touched on consumer confidence a few minutes ago. How big a role does the media play in this?
Yeah, it plays a big role, and I think this is it's quite interesting at the moment because there's a lot of media discussion around a capital gains tax, negative gearing, and making changes to that and making it better for young people. And the way that they see that as being is that if you get rid of investors, then first home buyers can get in the market because there's no investors. So it's a very simplistic narrative, but then ignores the fact that investors provide rental housing, and we need rental housing. So you're shifting the problem. You're shifting it from prices going up to rents going up. So and I think on that discussion, you'll read one form of media, if it's more, I guess, left wing, it will tend to say, get rid of investors. This is a way to solve it. You look at more conservative media and it'll tend to be a little bit more like, hang on a second, this is money. Why, money flowing into property, that is a good thing because it provides housing. And so it's a little bit more of a nuance. So yeah, I think it depends on what media that you're reading. And I think this is a challenge. I think that people face is that there's so much media, and also like sometimes you don't even know. I mean, sometimes I read things. I'm like, that is actually not true. And it's like I had a journalist ring me up a couple of weeks ago, and he's saying, if we get rid of investors, construction costs will go down. I'm like, how does that even work? Where did that come from? And it was, like they think that, and then they will write that. And as someone who's very deep in property, that's not true. And I think that's a problem at the moment. It's also misinformation, which is hard to untangle because there's so much information.
And unbalanced reporting, because I think you hear about a 0.25% interest rate rise, and the media will rush out and find some person who's going, "Oh my God, this is going to cost us an extra $1, so much per week. We haven't got it. We won't be able to buy food and all that sort of stuff."
You feel worse about yourself.
When in fact, if you look at interest rates over the last 20 odd years, we're down amongst the lowest interest rates that we've seen. So it could be a hell of a lot worse. And it's probably not going to be as sharp a rise and so on, but they panic these poor people and scare them into doing nothing. Won't take a holiday, won't do this.
I know.
It's very, I find
it's so hard too. I think when you read too much media, you kind of have to step away and you do have to take a bit of a breather from it because it can make you feel quite despondent.
So you talked about some changes to taxation and so on, and we haven't had any significant changes affecting real estate, although it is the most taxed of any asset class you can think about. Yeah. And I think about what happened only a couple of years ago in Victoria when the Victorian government put up land tax.
Yes.
There was 20,000 landlords sold their properties, got out of the marketplace. Now, it sounded great for
20,000 rental properties.
Yes. Yeah. And they lost a lot of land tax.
Yes.
Because
that's true
the investors sold and owner-occupiers would have probably bought them. And that sounds all terrific, excepting there's 20,000 less properties for people to rent. So up's gone the rents, more housing crisis for renters and so on. So these discussions about changing negative gearing or changing capital gains tax, is that just looking at revenue and not really thinking about the consequences?
Yeah, I mean, yeah. So I guess from a state and federal level, when they look at property, they look at the overarching revenue that's coming through. And I think this is the challenge in Victoria is that they need the money. So they've overspent. The government's in a terrible amount of debt. They need the money. So they need the money, but at the same time, they need to convince people that live in Victoria that this is the right thing to be doing. And this is why often the changes, my view, the changes that are being made to taxes on investors in particular is dressed up as something to help young people, when the reality is, when we look, we've looked at the data in Victoria quite a lot lately, because a lot of people are saying, oh, well, Victoria's good, they've taxed investors, it has become cheaper. And it's like, well, no, that's actually not what happened. What happened was they built a lot for decades, and they had a very strong development industry that just built a lot of apartments, built a lot of houses. They built more than they needed, and that has kept things much more affordable. What the taxes have done has shifted the pressure from price increases, which have been calmed down, to renters, which now rental growth over the past 5 years in Victoria has been far stronger than price growth, and it's the only capital city where it's been happening. And so clearly, those 20,000 less rental properties, which is tracked in the government's own rental bond data is clearly showing.
So this means we're starting to see, it used to be sort of a blanket coverage, things that happen in Australia that it happened all over the entire country. Now we're starting to see different markets. Victoria's not doing so well, but Queensland's doing phenomenally well. All this diversity, like, how does the average person figure out what's happening in my town? What should I be doing?
Yeah, it is hard. I think you're right. It is very, and it's different too, because for so long it was Melbourne and Sydney clearly doing better than the rest of Australia, and now it's completely the opposite. That Melbourne and Sydney are doing much less well than we're seeing in southeast Queensland and Perth and Adelaide. I think at a capital city level, it's clearly population growth, and those areas have seen a lot more population growth than other areas. It's a lot to do with how much building is taking place, which is harder to track, and then I guess the other part of it is sentiment too. I think the other, looking at somewhere like Perth at the moment, which is running at about 20% per annum, compared to Melbourne. Melbourne, clearly high levels of building has kept things far less elevated, but sentiment is very poor as well in Melbourne compared to Perth. So when people are feeling happy, and confident about the future, they will tend to spend more on housing than when people are feeling a bit nervous about their jobs, particularly. They think they might lose their job. They tend to behave quite differently.
So we're seeing that strength in southeast Queensland. It's gone from being one of the cheapest markets, one that people saw as high risk.
Yes.
Now it's running.
It was
second to Sydney.
Bank. They were worried about it. Brisbane apartment market leading to financial instability for the country at the time. So it's completely flipped.
So I get asked all the time about the Olympic Games.
Yeah.
Gee, it's going to make a big difference. Infrastructure, what are the key things that will change markets from that perspective? We see roads being built, so we see train tracks, we see, Olympic Games. How does this impact on markets?
It does allow people to move around more easily. If you look at somewhere like Gold Coast, if you can get into Brisbane quicker, or you can get around the Gold Coast quicker, it does increase values. There's certain types of infrastructure, for example, if a big freeway is ripped through your backyard, it's not good for your values. But if you're, within quite convenient driving distance to that freeway, it's very positive. Train lines are generally seen as better than, say, a bus line. There's certain preferences that people have. But also things like, a really good hospital can make a difference. A really good retail precinct can make a difference. There's a lot around infrastructure which does lift values.
I always say, people ask me about Southeast Queensland, the upcoming Olympic Games, and I go, it's a 2-week sporting event.
Yes,
I know. But what is actually the driver of some up benefits for property is whatever infrastructure is built that 100%. Goes on after the game. So sporting venues, or I see in the Gold Coast for our Commonwealth Games, we got the light rail.
Yes.
We had significant improvements in things like the casino. We saw the total transformation of Pacific Fair. Mm-hmm. And so there's about $18 billion spent. There's a second best in the Southern Hemisphere. And so they're the things that really do change property values. not a 2-week sporting event.
No, absolutely. And that's it because it is something we get asked, what will happen to property values? It's like, well, it's the infrastructure. When you have a look at every Olympics that's ever been done that we can get data for, it's not the fact the Olympics were on. The ones that have done well are ones that the government invested in infrastructure, and that was the everlasting benefit to the state or the city in which the infrastructure was developed. The other one, which will be really good, is like the train line up to Sunshine Coast Airport, for example. There's sorts of things that are really just suddenly Sunshine Coast is very difficult to get into because you have to drive.
It's all road.
It's all road, but you put a train in, suddenly that really opens it up.
Yeah. Tell me, methods of sale. There's always discussions about the best way to sell. How does that impact on prices? We often get people go, "Oh, we'd like to list our place, but we don't want any marketing. We just want to keep it quiet, but we want a premium price."
I know.
How important is things like marketing of a property, or the choice between, say, private treaty with just listing with a price, or public auction? How do they affect the markets in any way?
Yeah, look, they absolutely do. And we do have performance teams that track this very, very closely. And auction in particular, we know that, a set selling period, you will get the price. A well-marketed property going to auction, you will get the price that the property's worth. If you take it off auction and it stays online listed over a prolonged period, that's when you start to lose value. And
so the longer it's on the market,
absolutely. Yeah. I mean, you think of it as someone looking to buy a home. You do start to wonder what's wrong with that.
What's
property.
wrong with this? Why hasn't it sold?
So long, and then that clearly changes things. The other one is of course good marketing. That you can't sell a secret. You need to be able to tell as many people about the property. You need to present the property in its best light. All of these things are very incredibly important in selling.
Have you seen, like, the last 5 years, obviously, the majority of people have chosen to go auction. Is that played a significant role in driving prices sharper, the competition amongst people?
Yeah, I don't know. I mean, I suppose, we do say we are the competition creators, and, that is a key element of why we tell a vendor to go to auction. Has it an increased value? I mean, I suppose for some properties it would have. In terms of the clarity of from a buyer and seller's perspective, I think it's a good way to sell, because on one hand, the seller can clearly see, well, that I have seen what was out there. There was that many bidders. They got to that level. That must, I would think they would believe that's the worth of that property. From a buyer's perspective, I do think it is quite a stressful way to buy for people. But then at the same time, again, it's very transparent that there is someone else buying that property and they were prepared to pay more than you.
Yeah.
So, so I guess in terms of that, it is positive, but I do think on a buyer's perspective, I do think a lot of buyers find it quite stressful.
I think a well-marketed property that does go to a public auction is probably the greatest form of valuation you can get.
Yeah, that's true.
Because you go, well, I've seen 5-6 people, they dropped out.
And they're not made up. There's a lot of changes that have been made to auctions to make sure things like dummy bidding don't longer exist. And so I think that clarity is very important.
So we've had a market 5 years that has just been extraordinary.
Yes.
Phenomenal property growth. And that could never continue.
No, I can't.
Forever. So we've talked about some of the drivers of real estate. In your forecasting and you're looking forward, what are you seeing? What would you say the key factors are now for you to get a feel for where the real estate market's going for the next, say, 12 months?
Yeah, I mean, obviously short term, definitely interest rates. We can see already that the 2 rate rises that we've seen have slowed markets down, which, is as expected. We've seen a drop off in number of people attending open homes. We're seeing in February and March, we actually saw price growth slow. So, all of those things are flowing through. So short term, we do expect price growth to slow. Overall in Australia, it would be highly unlikely we'd get annual declines. It's running at sort of 10-12% at this point. So it'd have to be like a massive, you'd have to be full-blown recession to get to negative.
Do you see a recession?
No, I don't think so. I think I don't. I know people do criticise
Borderline.
the RBA a lot, but I do think they do handle things well, and they do make informed decisions in the way they're handling monetary policy. People don't talk about the crashes. Like every time the market turned, you'd always hear those people would come out and talk about a 30% price decline. I think they've hopefully now more educated around how markets work, but we haven't heard them for a while. I'm sure someone will pop out soon.
No, we haven't. Yeah, but I think back through my journey. This is the longest period post the global financial crisis back in 2008. It's the longest period without a recession. It's almost like people don't even know what a recession is.
Yeah, no, that's true. Yeah.
Yet the period of time before it, the 50 years before it, they were about every 7 years.
Yeah.
It was a
the
regular
early 90s
occurrence.
was a terrible time.
Oh, shocking decade.
Yeah,
shocking decade. So I guess for those who've been around for a while, they do recall some of those periods of time, which is where you saw the sharp drop in prices. Just touching back on a couple of things, taxation.
Yes.
Would that have a big effect on the market? Would you see all of a sudden a lot of people say, well, I'm selling out. I don't want to be subject to this. Or do you see people factoring into their purchase prices? Or how do you see that? Maybe investors saying, oh, invest in something else.
Yeah. Well, it depends if there's changes, it depends how they're structured. So if they say grandfather, if they say anyone who owns a rental property, your CGT will stay at 50%, you can negative gear, I wouldn't be selling.
Do you see, imagine negative gearing being affected or eliminated and increases in capital gains tax. That's pretty profound.
It would be very profound, and it would definitely lead to less investment.
Yeah. Hey, listen, I could talk all day. Give you 1 minute. What's your forecast for the next year?
Definitely a slowdown in house prices. We've got interest rates increasing at this point, so we do expect a slowdown. But longer term, price growth will continue because we do continue to see very high construction costs. Population growth is still happening, and of course, supply remains a key issue.
Any sector of the market that might be at risk? Higher value properties, lower value properties, any particular segment?
It doesn't seem to be the top end of the market that's slower at this point. The cheaper end does seem to be moving a lot quicker, primarily affordability, but also a lot of very generous incentives for first home buyers. So first home buyer levels have jumped and are at record highs in some places.
All right, let's have a date and catch up more often.
Sounds
I'd
good.
love to do that. Get you up into southeast Queensland in particular, look at some of our unique features that made Queensland such a strong marketplace.
A place people want to be.
Thanks, my friend.
Thank you.
Thank you very much.